We, of course, have also made some choices around businesses. And it is somewhat difficult for some of the businesses where we have designated them as non-core. But let's just be really clear what we mean by non-core. I've designated businesses that have lost us a lot of money and there are no investor appetite as non-core. Businesses we haven't been originating anything in and we haven't been doing anything in for the last year. And surprise, surprise, we won't be doing it anymore. First type of business that's in there. Second type of business is, and that they are businesses such as the credit correlation book, the residual principal strategies businesses in some of our trading businesses, which are fundamentally book building stuff we couldn't sell. They are the businesses that are stuck underwrites on deals that died. Blindingly obvious that we really probably don't want to go back there again. The next set of businesses, which are a little bit more difficult to put in, but necessary at the same time, is we could originate structured real estate transactions all day, every day. We could originate leveraged finance transactions all day, every day. We could originate long-dated project finance, liquidity-hungry businesses or debt all day, every day. But there's no investor market. We cannot find deep and large enough distribution markets for most of these businesses today. Because you can't find the other side of the trade, you're just perpetuating the use of your own balance sheet passively into the future, and you mortgage every other business in the bank. So we have, for the avoidance of doubt, very clearly stood up and said, these structured finance businesses are businesses that we today do not see a medium-term market for finding both sides of the trade, and therefore they are businesses that we are withdrawing from at this point in time. And that's quite hard for me because I used to run the leveraged finance business. So to go along and take a business you used to run and that you believed in and say, actually this is a business we shouldn't be in anymore for now, you have to think hard about it. So we have had our head under the bonnet of the bank, looking at the engine for the last 14 weeks. We have been taking it apart in terms of all of the products we are doing, all the clients we are serving, all the geographies we are participating in, and we've come up with a set of answers. And those answers are what we represented on the 26th of February. They are the answers that will be time and time again stated as the core strategy of what we're trying to achieve. And we hope we got it broadly right. Now, there will be things that we have done that some of you disagree with, and there will be things that we have done that some of you violently agree with. But at least we're making choices. And the key point is we have to set out what we're trying to achieve, and then we have to rally around those sense of what we're going to be as a business. There are other businesses in the non-core which are really around businesses that strategically don't fit the customer proposition. So let's just take aviation capital as a business. The aviation capital business we've got today is a great business. It is fundamentally one of the best organized aviation finance businesses, both operating lease and financing businesses in the world. It's the third largest in the world. We built it from a very small business to a very strong core business. But if we didn't have it, our customers would not be offended. And we deploy capital against those businesses. So we have decided to designate that very good business as non-core because fundamentally it uses capital capacity for customers that we need to serve in the bank going forward. I can go on and describe all the businesses. But there are some other choices we made. I've been in front of the UK government investment sort of buffer, UKFI, our shareholder, and describing the strategy to them, which they now have endorsed and agree, by the way. And two of the businesses we discussed in detail about why we are still in them are commodities and equities. Now, everyone in the room will have said, has a view on whether you should be in equities or you should be out of equities, given that we are sort of Europe and Asia, not US, and our business could be described as, regional and missing one of the largest cash equities markets in the world. We are categorically staying in equities. We think it is additive to the customer proposition, and it's additive to our fixed income plus proposition that we're trying to create across the world. So for the avoidance of doubt, we are in equities. We're out of Principal Strategies Group in equities. We're broadly out of the fund-of-funds financing business we've been doing. We don't intend to finance Bernard Madoff anymore. A bit unfair, sorry anyone in equities in the room, but each of our businesses have done things they shouldn't have been doing, and we're out of those businesses. We are categorically in the equity derivatives business. We are categorically in the financing business for equities because otherwise you wouldn't have counterparties to trade with. But we're in equities, and we're in it in all the shapes and forms that you would expect us to be. We are actually, and you will have seen that we are in equities. We underwrote HSBC's equity 2 weeks ago. ago. We had a frightening moment last week when the share price went a little lower than we'd hoped, but it's back now and we're all breathing well again, so very happy. We are also in commodities. The commodities business is a joint venture with Sempra. It makes enormous sense for us to broaden our footprint to ensure we have the commodities and the physical commodities for our customers to invest in. We have a great business there. We are categorically staying in that business. We are in U.S. mortgage trading. Surprise, surprise. We're out of non-conforming, independently originated subprime U.S. mortgage origination because that's a crap business, right? So we have made extremely digital choices about the businesses we need to be in, and we have made pretty significant choices as well on the geographies that we are in. We're in 54 countries today, and much of that was through the broadening of the network that was ABN AMRO. ABN AMRO was in 54 countries, RBS was in 22. So we ended up with a wider network in 54 countries. But there is a lot of strategic tourism in there. We are in places sort of broadly visiting, but not really doing anything, right? So it's a good phrase, I like it. We make 90% of our revenues from 15 countries. So the other 40 countries, we make the 10%. Now actually, we're only proposing to get out of 10%, or 15 countries, because those countries we cannot categorically see a reason to be in it, whether it be the extension of the GTS network, whether it be a local markets capability. So we're exploring new ways of owning those countries, or we will close them. But again, you can't do justice to an individual country on a slide which has every country bucketed in 3 categories. We have to actually go and talk to the people in those countries about the lives that we're just about to impact. 28 countries we have identified as refocus. It's a beautifully vague word, right? But what it means is, where we've started hubbing activity on those countries, we will continue to hub activities in those countries. Where we don't need to be onshore trading to achieve our objectives in those countries, we will not be onshore trading in those countries. Where we don't need to have a physical presence in all of our categories of product or coverage, we won't. We are just looking at the model we've got there because we think we have an overemphasized, too invested model around those 28 countries. So, and most of it's already started, by the way. So this is a stocktake of where we were at as at the 26th of February, rather than stuff we dreamt up for that date. Right. And then there are 12 countries where we fundamentally need to reinforce the fact that they are core. And you'll be pleased to know that the Netherlands is one of those core countries. And hence I'm not wearing any armour today. It is very important that you guys know that RBS is committed to the Netherlands. We have 2,000 plus employees in the Netherlands, whether it be in GTS, in the core hubs of manufacturing, whether it's in the current mid-market offering, or whether it's in the GBM sort of Rolls-Royce coverage offering, or the product areas. All of that adds up to a very sizable piece of the workforce of RBS, and the Netherlands is core to the future of RBS and committed. I wanted to talk a little bit about the management of GBM as well, because one of the great criticisms I've heard, particularly as people get fueled with alcohol, is that the management of GBM wasn't transparent, and the management of GBM didn't communicate very well, and the management of GBM just made rubbish decisions and should have consulted us. And I know in the Netherlands consultation is very important, having lived here for a year. So the bottom line is we've changed it. We have taken away a number of the cottage industries of how we run our business. We've created a single markets business. We've created a single origination, advisory and coverage activity. I've made the portfolio important because we are long by about £500 billion of credit risk across the undrawns, the drawns, and the derivatives book on collateralized exposure. We're very long credit risk, and I want it at the table being understood and being managed. And the non-core. The non-core, if I put 200 billion of funded assets into the non-core, and I've got 125 billion of risk-weighted assets against it, it's probably reasonable I should be keeping an eye on it. Now, that doesn't mean we then put people into non-core, run them down, and tell them they haven't got a future. It's about having as few people as possible around understanding and driving the non-core, and matrix managing back in as much as possible into the core business, the day-to-day routine management of assets that have been designated as non-core. And funnily enough, we have 3 regions. easily described, don't need to be explained. And then we've got our functions, which again are very, very important. And I'll come on and talk a little bit more about what we're going to do with the functions. And there's some themes. And I think the themes are very important for us to just get in our heads as we come to work every day and get very enthusiastic about building this bank together. The first one is risk management. We, like all of our peers, have got a little bit complacent in how we manage our risks. Doing things like managing on single measures like LGD is all very fine as the high investment grade company comes onto our books. But we tend to go and have trouble when they're no longer a quality investment grade name. So we need to think about things, about stress, about concentration, about sector limits, about a lot more sort of intelligently about multiple measures of risk and forcing the business to think hard about those measures. We have in GBM, 606 names over 350 million pounds of exposure. And we have over 100 names over £1 billion of exposure. And we haven't, in my view, taken counterparty exposure management to any form of sophistication across our business. And we need to. We need to get much cleverer about how we understand the risks we're running and drive the risks. And for example, a simple thing we've done is we've introduced on a Tuesday now a discussion of risk. Surprise, surprise. Let's run a bank in which we manage risk. And we may just have a daily meeting which unveils what the VAR is, what the stress is, what the strategies are, and how we're running the market risk. Not that we weren't running market risk, but we weren't sharing intelligently at the management table very clearly the risks we're running and how they're changing week on week to create a culture of risk awareness in the firm. And that is something that we need to drive as we go forward. Again, it's treating people as adults. RBS and ABN AMRO have always been client-focused. They've always been businesses that put the client firmly at the centre of everything they've done. And I think over the last year, while we wanted to do that, we may not have had the individual or collective confidence to do it. We have to get back to doing that. Our customers are our complete lifeblood, whether they're buying product from us through the sales side or whether we are originating the opportunity through the strong relationships that we run and value in partnership with those customers. We have to make sure we have resilient products in the face of our customers and that we are really client-focused. And as part of that, I'll be reinventing the values of GBM a little bit just to get us back to delivery, partnership focus, just changing the values a little bit, and I've got a working party on that right now, just to make sure that we really and collectively think about what we want to be in our DNA. And it isn't right that one firm, whether it be ABN AMRO or RBS, imposes its DNA on the other. I think the events of 2008 and late 2007 and continuing in 2009 mean that it's time for us to invent the new business and invent the future for us as a collective go-forward institution. Infrastructure and control. We have some horrible infrastructure at the back of the business. Some absolutely awful risk and finance and collateral and et cetera systems at the back of our business. And we're not yet finished integrations. We've got two banks who have reasonable front office systems, some okay back office systems, but broadly unwired, right? So we have, if you took our 10,000 back office people, 1,000 of the 10,000 people in the back office do data cleanup and reconciliation. You do not want that on your gravestone. I was a data cleaner. It must be one of the most soul-destroying things to do for your life, right? We have to rescue our people from that shit. Excuse my language. So, as an example, we have to try and invest in sorting out the process engineering and where we draw the lines and the routines and where we allow computers to do the work, because computers actually always do the work better than human beings. Human beings are prone to error, right? All of us. I know many of you never made an error, but I have made errors. And we're going to invest £600 million, and it's already approved, and it started, and it kicks off on the 31st of March. We're investing £600 million, so $1 billion nearly, in our technology over the next 2.25 years. And we would expect that will improve dramatically the connectivity front to back and across the bank. And it will also reinvent the way we can organize our back office. So, and all that's coming to a cinema near you over the course of the coming few months. Distribution discipline, something I actually want us to just get into our mindset. We've been pretty good at distributing our trading risk, crossing bonds, doing bid offer, trying not to build up our inventories in stuff that's too long dated. We've been reasonably good at doing bond distribution and reasonably good at doing syndicating loans and moving risk off. And of course, we all got stuck with some underwrites at a point in time when everyone did. But we still have that big long credit position that I talked about. We need to get a distribution mindset around the firm, which is constant. Everything is for sale all the time, depending on the economic conditions and the relative value. I want everyone in the room to come to work wondering, could we sell something? Because it creates capacity for new business with our clients. Not about not serving your clients. It's not about not putting credit available to your clients. We absolutely intend to continue to provide credit to the clients we've got. And again, which I haven't talked about, is the metrics around the core. We expect to have about 150 billion of risk-weighted assets attaching to the core. That's about £500 billion of funded balance sheet if you gross it up for the various types of risk we'll be running. There'll be a large derivatives book on top of that. We'd expect to have about a third of that, maybe a little bit more than a third of that 150 billion in the provision of credit to our customers, which again, scaled up is a very large level of provision of credit to our customers. But we need to be clever about how we deploy it. And we need to be constantly trying to create room to do new things with our customers. But we can only do that if we get an absolutely clearly defined trading mentality into the way we think about not just the trading businesses, but also the loans businesses and any other type of risk we're taking. And of course, to do that, you have to deploy capital. So, it's all very well for me to come up and sort of set out the broad ambition and then leave you to do it. Right now, I'm slightly doing that, but at the same time, we've got a piece of work going on now, which is taking the products globally and splitting them out by geography, and then taking the geographies and checking the products across those. So trying to triangulate what do we think over the next 1, 3, and 5 years is the ambition of the business? What is the resource deployment required of the business? So if I am going to try and get back to a £10 billion business over a period of 3 to 5 years with a sensible return on equity and a business that we can all be proud of, well risk managed, what is the level of capital that our products in country or our countries will require, so our client organization, and what do I think our products will require as well? And we're trying to triangulate the two of those during the course of the next 6 to 8 weeks. So there's a big exercise going on now, and I apologize to anyone who is deeply embroiled in that, but actually we need you to do it, because without that tension and creation of that matrix of what do you think you need, then capital allocation just becomes a general discussion, not something you can actually focus on. So I want to have the client organization organized by geography telling me what you think you need to achieve, what you want to do in country, and I want to have the global products telling me what they want to do across the world, and I want the two mapped. And that's ongoing as we speak, and I think that will end up in a very healthy and enjoyable debate around the table as to who gets the capital, because it is finite, and we have to be deploying it where we think we can maximize the flow, maximize our franchise, and ensure that we have a business that we can all be proud of and that you can deliver on the targets and we can all be happy again. And of course, we need appropriate incentives. So this year has been pretty violent in terms of incentives. We've gone from all cash to all deferred. We've gone from proud to pay to hard to pay. We've gone from an industry that was regarded as one of the best industries for any of us to work in, that we want to tell our neighbours we were bankers, to going back to saying you're a student, or to any other description, you gardener, whatever you could find that you were good at that wasn't banking, and we're now describing ourselves that. We have to get beyond that. We have to get back to a place where we are proud to be and proud to do what we do, and we need to stop thinking of ourselves as having replaced prisoners and prostitutes and politicians at the bottom of the social order. And of course, we need appropriate incentives. So this year has been pretty violent in terms of incentives. We've gone from all cash to all deferred. We've gone from proud to pay to hard to pay. We've gone from an industry that was regarded as one of the best industries for any of us to work in, that we want to tell our neighbours we were bankers, to going back to saying you're a student, or to any other description, you gardener, whatever you could find that you were good at that wasn't banking, and we're now describing ourselves that. We have to get beyond that. We have to get back to a place where we are proud to be and proud to do what we do, and we need to stop thinking of ourselves as having replaced prisoners and prostitutes and politicians at the bottom of the social order. So we have a written agreement with the government that we will be paying people against our peer group, and that we will be paying competitively against that peer group, and it is something that is very important that we need to believe. Now, we've all had our disappointments on comp, we've all had our disappointments on how processes ran during the course of the last while, and it was a pretty exaggerated and violent time. But we have to believe, and I believe, that we have an agreement with our shareholder that we can go out and build a business by reference to our peers and pay our people by reference to our peers. And that's what we need to go and try and do. I talked about the infrastructure, so I'm not going to talk about any more about that. And of course, we have some targets that I have in my head. And by the way, these targets are not things that I'm nailing you to. These are the things we need to try and aim at achieving over the next 3 to 5 years. We need to get the core business back to being about 10 billion. Now, you might say, well, that's enormous, but it isn't, actually. In 2007, GBM as a business made £10.9 billion of revenue. In 2008, even though you look at the accounts, it's negative because of the drag from historic investments. We made 10.2 billion of core engine room revenues. And when we split out the core and the non-core, we're back to somewhere shy of 8 in the core, and we should be able to build that back progressively to a 10 number. And we can absolutely generate a return on equity of 20% plus on that core business, and we should be able to do that without dramatically driving for growth. We should be able to do that by making sure that the shape of our business is a properly organized shape, and that we have a business that is that we can be proud to explain as well risk managed, well organized, well invested, and customer centric. But before I turn to the usual deep questioning from the Dutch audience, I'd just like to summarize a couple of things. The first one is we have a business that is now financially stable. Now, you might say, well, you've told us that 3 times now, you guys. You know, April, September, or October, and now again. Why would we believe you? Well, let me just pause on that for a second. In the first 2 rights issues, there was a reaction to an urgent need to raise capital. This time, we've spent 14 weeks absolutely ripping the bank apart and understanding in detail what are the assets we've got, what are the risks we've got that we can see, modelling those risks, subjecting those risks to our own subjective views on how we think the world is going to go. And we've identified across the RBS group 300 billion pounds of assets that we believe have some issues. That doesn't mean they're all going to default. It just means that there is stress characteristics on those assets. And that were we to identify those assets as potentially problematic in a very stressed economic scenario, what would they do to our business? And what we've done is we've catastrophe insured those assets. So we have fundamentally looked out across an economic cycle and said, in 1,000 days' time when we come out the other side, if we put this insurance cover in place, do we survive? And the answer is yes. So, and not just yes, but actually we put the capital in today to cover those losses. So the core tier 1 of RBS has now up beyond 12.5% core tier 1, and it is fundamentally capitalized to cope with first loss and a very dramatically negative economic environment. You have to believe that we've done the work properly to do that. And we'll have got some of it wrong, so there'll be stuff we will lose outside the insured assets, and there'll be stuff in the insured assets that goes fine that we thought might go wrong. But fundamentally, we've put a catastrophe cover piece of insurance in place, which means we will be here. 40% of the UK's GDP goes across RBS's computers every day, and 80% of the GBM balance sheet is non-sterling. We're more reliant on the Fed than we are on the Bank of England or the ECB for our funding. We are absolutely intrinsic to the global economy. We are one of the only 16 counterparts in the whole world that you would trade a derivative with in size. So we are here to stay. We have been singled out by the actions of regulators and governments to survive. And there are many other banks around the world who will follow that path and be clearly identified as survivors, and you know many of them yourselves. But RBS is one of them. Now, if I took to the share price, which is a slightly different matter, the share price is not well. Right? It is valued as an option. Right? and I've said this earlier on, if you went to buy an option on our share price, it costs you nearly the same as the share price because you're buying an option on an option. So we need to kind of ignore the share price for a bit because it's just extremely annoying, right? And it just puts you in a bad mood. So if you want to think about the company you work for, you need to think about the CDS price and think about the stability that we've got against other banks. So our CDS price trades just off the sovereign in the UK sovereign, and it fundamentally says this bank is supported. Now, of course, we want to get back and away from that and completely independent. We want the share price to rocket and we all want to get rich. But that's probably not 2009. Might be a little bit later, right? So I don't anyone to talk about the share price anymore. You're banned from talking about the share price. Today, just today. I think 2009 and 10 are going to be challenging years for economic environment. We've put our people through a lot of stress as well during the course of the last 18 months, and actually in Aben Amro's case before that during the bid battle as well. So it's been a kind of an awful 2 years for one reason or another, particularly for people who were supporting the corporate activity and were not the professional market people, because actually it's been a very, very interesting professional market. And we have to recognize that. So we kind of need to draw some lines in the sand and say to ourselves, is there a future? Do I believe in this future? Do I believe that the management of RBS, of the Netherlands, of the group, is, one, telling me the truth, two, giving me the best chance of survival, and three, worth backing? And you have to make those judgments for yourselves. But I would say that I think RBS is well set up now to face forward. I think we have been one of the few banks with the new leadership we've got through Stephen and other changes to actually absolutely and categorically acknowledge where we think we needed to change. We've put out a strategy way ahead of most other banks in terms of its detail, and we are out on the road communicating with you guys to try and get you to believe in what we're trying to do. The strategy is backed by the board in detail, enormous detail, and it's backed by our shareholder in detail. Now, you notice I'm using the word shareholder rather than Gordon Brown or the UK government. I'll talk about the UK government in a minute. It is backed by them because they have explicitly, through the work by putting UKFI in as their representative as an institutional shareholder, they've explicitly said, RBS, we recognise that you have a strong, important piece of the UK economy, which you operate through the retail bank and the UK corporate bank. But we've also grown to recognise that you have an enormous wholesale bank which operates across 54 countries, soon to be 40, and across all product classes, and we back that. We back the fact that 80% of your balance sheet is not sterling. 80% of GBM's balance sheet is non-sterling, and the government, our new shareholder, recognises and endorses that. Now, when you put £50 billion into a business like RBS, you'll be rather foolish to say, I don't want half the profit, right? Because then you have no chance of getting your money back. So this is a commercial decision by the new shareholder to back us as the management, to drive this business forward, to unveil it as a good business, and then to repay them at some point in the near future. And that's what you've got to believe. And I've been in front of the government only 4 times since taking the job, and I've been in the job, heading for 5 months. So they're not on my case. They're on Stephen's case, well, but he does a great job of keeping them away from the divisions, right? That's his job, is to deal with the shareholder. The shareholder happens to be the government plus the minorities. That's his job. My job is to run the division and get as much space for us to run the division as possible. And I'm getting that space. So not too often down at Whitehall. Have not met Gordon Brown, thank God.